Cool. All right, everyone. Welcome to the Roger Shan Show. I've got a very special guest, Mike Khouw from YieldMax. Mike is a spokesperson and strategist for YieldMax who brings over 25 years of experience in the financial markets, widely recognized as one of the leading voices in options trading. He is a co-founder of OpenInterest.pro, a longstanding contributor on CNBC's Fast Money and Options Action, and the co-author of Options Edge. So Mike, thanks so much for taking the time to speak with me and my audience.
It's my pleasure. Thanks for having me.
Okay, so we'll just get right into it. Maybe you could tell us a little bit about your background. I know I gave an intro, but what drew you to YieldMax and what about your background made you kind of the right person for this YieldMax strategist role?
Sure. So I'll try to blow through my professional experience. As you pointed out, you look quite young to me, so I'm going to assume that I've probably been at this for about as long as you've been alive. But in the 1990s, I started in the business as an options market maker. So I began on the Philadelphia Stock Exchange. We had a specialist operation there. I also did what we call statistical volatility arbitrage. That's basically trading the relationship between index options and the constituent stock options. So if you comprise an index, and what are the prices of all the options on that versus the prices of the options on the index. I did that on the Philadelphia Stock Exchange and the American Stock Exchange. When that firm that I was working for, a firm called Gateway Partners, sold to Knight Capital, Knight Capital became famous several years later when they blew up quite famously. They had their own sort of disastrous algorithmic trading error, which I encourage people who are interested to read a story because it's kind of interesting. So I then went to the New York Mercantile Exchange, traded crude oil futures, natural gas futures, and options on those. So we were options traders, but it was options on the futures for those two. And then from there, I went to a deep dive, sort of private equity approach, long short hedge fund based in Los Angeles called Ivory. And then somebody I knew from my old options trading days, who was then at Cantor Fitzgerald, called me up and said, hey, Cantor Fitzgerald wants to get into the institutional options trading business. Now, they had a big what's called IDB or interdealer business, which is basically they brokered transactions in options between banks and dealers, but not with customers. For us in the institutional space, customers means hedge funds, mutual funds, things like that, pensions, trusts. These businesses are not always compatible with one another, and they needed somebody to make markets in those options. So I went over there and did that. I made markets in the options and ran that group for a little over 5 years. And I did basically the same thing at a firm called CRT Capital. And then from that point on, somebody that I was doing business with in both of those two firms, they had built a fintech business that actually now has a huge and disproportionate percentage of the institutional options flow on the electronic side. A company called Dash, the founder, reached out to me, and so I've been doing basically fintech since then. Everything I've done in the business basically since those CRT days, actually even since Cantor, was when somebody called me up and said, hey, we have a problem. We think you're a good fit, and maybe you could come over and lend a hand. And that's how I came to YieldMax. So I happened to be, it was actually with the founder of Dash, actually. I was doing a video, like a live stream, kind of something like this. It was on YouTube. He and I were talking about options-related strategies in the ETF space. Misty came up, and we started talking about it. And I said, I think these products are not very well understood. I think people are looking at them the wrong way if they understood what they are. And how they should fit into an investment portfolio and how to think about them. They wouldn't be dealing with a lot of these kind of, frequently asked questions, false narratives and stuff. Now, what I didn't know was that people from YieldMax were watching that video. And I have a Bloomberg terminal, and probably 30 minutes after that thing wrapped up, I got a message on my Bloomberg terminal from one of the people over there. It said, hey, can we talk to you? And I said, sure. That person was Scott Snyder. And so I ended up on the phone with Scott and Jay Pestricelli. And then later I flew to New York to meet with Mike Venuto and a couple other people. And they said, you know the option space, you know the fund management space. I've had some experience in the ETF space as well. So they said, perhaps you could come over and we can, take a look at some of these strategies, and maybe you could also speak to people who, maybe don't understand them very well. You'd possibly be a decent spokesperson for it. I don't know whether I am or am not, but I certainly have talked a lot about options in my professional life. So I thought, okay, this sounds like an interesting opportunity.
Cool. And I would imagine, I think I know the answer, but I'll let you go. What are the common misconceptions people have about these YieldMax funds? I think one might be the return of capital or NAV erosion myth, but are there others that you see?
I think, well, actually, I would start with a couple of things. One of them, I mean, those are important topics, to be sure. I think that people have to understand that YieldMax there's a family of different fund products, and each have different utility. So the single stock covered call ETFs would be, we'll start with that, because a single stock covered call ETF is not a fund in a conventional sense. They bear the name fund because they are an ETF, an exchange traded fund. But they aren't a fund the way that most things are. They are intended to be a democratized product that wraps a strategy around a single stock that makes it possible for people to invest in that strategy who might not otherwise be able to. So, for example, a lot of people know what NVIDIA is. Maybe people like NVIDIA. Maybe they like to do covered calls on NVIDIA. Maybe they like to do covered calls on NVIDIA and AMD and Strategy and Tesla and, pick a list of stocks. But maybe they also have a real full-time job and they're not options traders. And they say, I want that strategy, but I can't do it myself. Logistically, it's impossible. There are other reasons why it might be impossible beyond time. Managing it is hard enough, but there's also capital constraints. I'll give an example. If you're going to do a buy right on Netflix, Netflix $1,100, $1,200 stock, depending on when you're looking at it. So let's just call it a $1,200 stock to make the math easy. Well, to do one covered call, you have to own 100 shares because each call represents 100 shares. That's $120,000 worth of stock. And nobody's portfolio is probably going to be only Netflix buy rights. So if you only put 5% of your portfolio into each constituent of it, that means that you have to have at least $2.4 million in your portfolio before you could do a single buy right on Netflix. On the other hand, you could buy NFLY or something like that, and you could allocate just a few dollars to that strategy. So, and also some people don't have options permissions in their accounts, or they don't know how to get it, or they're afraid of executing the strategy improperly. These are meant to be, constituents of a portfolio that somebody can just buy and put in and allow somebody else to handle that. So that's the single stock covered call ETFs, and I think some people don't recognize even that much. I give you a good example. I have seen people who should know better, to be honest, people who are in the business, people whose job it is to evaluate the performance of funds and things like that, look at single stock covered call ETFs as if they were a fund, as if, this was what a fund manager did and we're going to evaluate their performance. I mean, you can imagine that it would be pretty silly to say, okay, well, how good a fund manager is this person? And then take a look at Misty, which is just a covered call on strategy. Mm-hmm. And then evaluate their performance as a fund manager based on that. So if you're going to look at the single stock covered all ETFs, you would have to take all of them and build a portfolio out of them. Also knowing that those things are demand driven, which means that it may not surprise you to learn that not a lot of people are interested in doing buy rights on Procter & Gamble or Kimberly-Clark or Kroger's, Staples, grocers, things like that. These are not things that typically are going to see a lot of interest. So you tend to have high beta stocks. You end up with industry and sector concentrations. So that's one piece of the misunderstanding I think that's important. The NAV issue and the return of capital are two others. Return of capital, I think we could talk about this one first. And this is usually the one that requires a little bit of explanation. And I think it's really important for people to understand it. Return of capital in the context of these funds is a classification associated with distributions and what the tax implications are. Now, it is possible for a fund to do very well and have return of capital. It is possible for a fund to do very poorly and also have return of capital or maybe just income. So you need to evaluate performance of a fund independently of how the distributions from that fund are classified. And I like to usually come up with a fairly simple example to explain a return of capital situation that is also a good situation. So we can walk through that. And let's just imagine that I have a fund, and in that fund I buy one stock, and that stock is $100. So I buy the stock for $100, and then I sell a 1-week call option that's 2% out of the money, like the 102 strike call that expires in a week. And I sell that for $2, let's say. All right. So that would be a stellar standstill rate of return if one could get it, right? Because that's 2% of the current stock price in 1 week, works out to 100% annualized. Nice standstill return. Now let's imagine that 1 week passes and the stock has now gone up to $110. All right. Well, I own the stock or a proxy for it, so I've made 10% on the stock. What happened to the call I sold? Well, it was 2% out of the money, and I sold it for $2, but it's now $8 in the money, right? Stock's 110, call's 102, that's $8 in the money. Now, either I do nothing and I have my stock called away from me or my proxy, or I have to buy it back. Now, in these single stock funds, for example, or in a lot of them, the normal thing that the fund manager would do is buy it back. And they can, because there's, in the single stock funds, for example, you've got treasuries or short-term treasuries, cash and equivalents that serve as collateral for the synthetic proxy. So you buy it back. When you do that, I sold it for $2, I bought it for $8, I lost $6, right? So I have a $6 realized loss on the call that I sold in week 1 and bought back in week 2. You with me so far? So we have a $6 realized loss, and I have a $10 unrealized gain in the stock. So if you put those two together, what did I end up with? I ended up with a 4% gain week on week, right? Because I made basically the difference between my unrealized loss and my realized gain. But if I distribute my gain, that 4%, to the shareholders, is that income or is it return of capital? And from the IRS's point of view, that's a return of capital. And it's a return of capital because you may not return an unrealized gain. You can only return a realized gain. And I don't have realized gains. I've only got unrealized gains and realized losses. So I made 4%, I distributed 4%, and it's a return of capital. That's within a discrete period of time. Now let's imagine we do the exact same trade. Only this time, things don't turn out so great. So instead, and these are arguments ad absurdum because I'm imagining 10% moves for the stock, but that keeps the math easy. So again, I bought the stock for 100. I sold a 2% out of the money call for $2, and the stock drops by 10% from week 1 to week 2. Now what happens? Well, now I have a loss. I have a 10% loss on the stock of $10, and I collected $2 on the option. How much money have I made or lost? I've actually lost $8. From 1 week to the next, I lost $8. And what if the fund manager says, okay, I'm going to distribute the $2 that I collected from my short call. I sold this call and it expired worthless. So that was premium I collected. I still have my proxy stock position, so I'm going to sell more calls against it, and I hand the $2 back to the investor. How does the IRS view this transaction? Was that a return of capital, or was that income? It's income. Now, this wasn't a good week. We lost 8% on the week, but I made a distribution, and that's now in truth, over a tax period, you really have to look at all of your realized gains and losses. But to the extent that distributions come back to investors, whether they get classified as income or return of capital is going to depend on the realized gains and losses that the fund actually experienced. And the funds will have interest on cash balances. We don't hold a lot of stocks that pay dividends, but if we did, there would be that. There would be short-term capital gains and losses and so on. So I think it's important to understand that return of capital for most investors is a good thing as a classification. If you could choose, you don't get to choose, but if you could, you'd much rather take a distribution as a return of capital because it doesn't have an immediate tax consequence for you, the investor. Well, why is that? Well, because if you hand me $100 and I hand it back to you, the IRS doesn't say, okay, you gotta pay taxes on that. Now, in the first example, we made money and I handed money back to you, but they said because that didn't come from the unrealized profits, we have to assume that this is the original money that came back to you, so it gets classified as such. When you return capital from a tax perspective, it lowers your basis in the investment. So if you had the stock, if you made, let's say you bought 100 shares of this thing, and let's say it cost 100, so you put $10,000 in, and if I gave you 4% as a return of capital classification, your basis has now dropped by 4%, so it's now 9,600, right? Instead of 10,000, your basis is now 9,600 or $96 a share. And when you sell your ETF shares, the IRS doesn't give you any freebies, unfortunately. There's no end run around it. So what ends up happening is that then you'll pay a capital gains tax. If you hold the shares for a long time, maybe it's a long-term capital gain. If it's short-term, it'll be short-term. But I think that's an important consideration. The other issue is NAV and NAV erosion. So NAV can go down for reasons that are not critical, and it can go down for reasons that are critical. So we care about NAV if we are concerned about the performance of the funds, and of course we are, right? So if I make 4% on a week, the NAV of the fund will rise by 4%. And if I then distribute 4% or 5% or whatever, it is coming out of gains, then that's not a problem. NAV erosion that comes from losses, and we will periodically experience losses. Anybody who's seen the single stock covered call Moderna, so we have one that's called MRNY. Moderna has lost 90% of its value since its peak. Now, there have been plenty of stocks that have done very well. We have one on NVIDIA. In some cases, you can go long or short, right? So there's Tesla and there's crash. There's a Tesla covered call and there's crash. But the fact is that if the underlying assets are declining in value, it's losing money. I mean, it really is losing money. And that will happen when the stocks go in the wrong direction, right? So I think whether you're talking about a single stock covered call ETF or one of the short ones, if you were betting against some of the things that have really rallied, that's been painful. If you were really bullish on Moderna, I have not been bullish on Moderna or Pfizer for that matter for quite some time because I just think the bloom came off of that whole vaccine story rose a long time ago. But maybe some people think it's going to come back. I mean, they may be right and I may be wrong. I don't know. But if you're in an option strategy that is fundamentally long delta, that means long the underlying, and the underlying underperforms, that's going to result in losses for the wrong reasons, right? So the NAV is going to be going down because the underlying assets are declining, and it makes a difference, right? So those are the things you have to be able to distinguish.
Cool. You mentioned in, I think, the first example that if the stock goes up, there may be instances where you want to buy back the call so that you don't get assigned. How often does that happen in the ULTY portfolio, or do stocks ever get assigned in ULTY? Are you guys always buying back the calls when you see that appreciation? Does that question make sense?
Assignments can happen and periodically do happen in any fund where you have an American style option. And the reason is because the holder of an American style option, if you're short an American style option, the holder can elect to exercise that at any time and for any reason, even if it's not optimal for them to do so. And that does happen. So periodically you will see assignments take place. So you think, like, why did we should not have been assigned because it was not optimal to exercise that option early. But Otherwise, the only other way that you would be assigned is that you carry a short option all the way until expiration, and it is in the money.
Mm-hmm.
But because these positions are dynamically managed and they're rolling positions, that does not happen. So assignments do happen, but they happen infrequently and usually not for the entirety of a position. It's a common thing in the beginning of a trader meeting for the traders to sit there and say, I got an assignment in XYZ stock. I shouldn't actually we used to use XYZ as like the generic stock, except that XYZ is now blocked, so we can't do. XYZ is not a generic stock anymore, but generic stock, whatever, A, B, C, D, E. So we got the following assignments, and they'll just cover the equity positions, and it's not a big thing. In general, though, that's not what happens. Positions are typically adjusted before an assignment would occur. So,
Mm-hmm. And is that expensive, or can that be like detrimental to the credit that you're receiving from that premium if you keep rolling the position and maybe the stock's going down, you're not getting as much gains as you had before?
Generally no, because when the assessment that the traders are making when they make an adjustment is that the rate of decay for an existing options position is no longer sufficient to justify carrying it. Now, it should be said that the options positions in some of these funds may not be as simple as just a straight covered call. Long the stock, sold the call. You may be short a call spread, for example. So there are circumstances where they don't adjust right away because let's say you own a stock. We actually saw this in AMD a couple of weeks ago, and actually NVIDIA also. So people who noticed that we had positions in NVIDIA and AMD. In one of those cases, NVIDIA had like a 15% rally in 5 or 6 trading days. And the covered call ETF was up about 11.5%. Now, that normally wouldn't happen because if you were just long the stock and short a covered call, your gains would typically be capped. But in our case, we got some participation because we had sold a call spread, not just just call. So when the stock actually ripped, it ripped through the call spreads, and they just said, okay, fine, we're going to let this run. Now we're participating 1-for-1 with the stock. So if the stock had stayed put, we would have been paid money. And if the stock had declined, we would. So if there are 3 things that could happen, and the stock could rise, it could fall, or it could stay where it is. In basic, if we think about it very simply, if it had stayed where it was, we would outperform because we were short premium. If it had fallen, we would have outperformed the underlying because we were short premium. And if it went up, we would underperform if we were just short premium. But because we sold call spreads, we didn't underperform by that much. So the trade-off for being short premium turned out to be about 3.5% of the performance of the 15% that it got from one week to the next, which I think is a pretty good trade-off and shows the merit of doing that. So just like you would do if you manage covered calls actively yourself, if you see, wait a minute, I'm short this call and there's almost no premium left in it. Do I want to stay short that call? I don't want to be short 2 calls because now I'm taking excess risk. So I don't want to have the risk of being short stock if it rips. So you now have to say, well, I'm going to get paid more to roll this thing at this point. And in fact, I'm going to get paid more in real time. So if the decay on an option that expires in a week is greater on a daily basis than the one I'm still short, then I should probably look to roll it. So they will make those adjustments in real time, and that's what they're doing.
I wanted to now pivot just to talk about the ULTY strategy.
Mm-hmm.
Can you kind of explain the stock selection process and maybe how the managers decide what to buy and when to buy and how much to buy?
Yeah. So if you take a look at the fund, and actually, you know what? I'll just pull it up right now so we can just take a look at the respective weights and positions. And this has changed. Anybody who's watching ULTY will probably have observed that there have been some changes to the kinds of things that are in there. ULTY was intended to be a portfolio of stocks that could generate a lot of options premium. And so the portfolio manager's priority was that first. They were not thinking about capital appreciation so much as they were thinking about premium. And what that does is it will lead you to stocks that tend to be high volatility and have high implied volatilities. After all, if you're selling options premium, that's what you're getting. And so that was a very important focus in a strategy. And that did work. It certainly worked between the Liberation Day period and the highs in early October. So those who know the trajectory of my own participation at YieldMax, you'll probably know that I'm a relatively recent arrival, right? So some of this predates me. But that was the logic. And the thing is, if you have a fairly large basket of stocks, and let's see how many stocks are in, individual stocks are in here now. We've got about 22. We have 22 stocks in it right now. The largest one, the weight is just under 6%, and the smallest one is just over 2%. Right, so you're dealing with an average of probably just over 4%, and the largest one is maybe 125 basis points larger than that. That would be Palantir, and the smallest one is, maybe 60% of that number. I think two things have been introduced recently. One of the things I think we can safely say is that after October 9th, we saw the crypto space roll over, and it rolled over hard. Now, at the time and in the period immediately following, we've seen names like Coinbase was in there, Strategy was in there, Bitmine Immersion was in there, Cypher, I think, was in there if I didn't mention that one already. And that meant that, and this is not surprising, right? Because first of all, this was not only a high flying space earlier, but it's a high vol space, right? So it's a target rich environment from an options trading point of view. But unfortunately, that's a double-edged sword, right? So what lent tremendous strength, I think, to the portfolio during a 55% return between early April to early October, that when that space rolled over, all of those names got hard hit, and many others besides. A lot of the high-flying stocks in general, and many were in there, that weren't necessarily directly related to the crypto trade, but, are definitely part of the risk-on, risk-off mentality in equities more generally. I think that they were affected by that downturn. So, when you and I first connected before we went, you started recording this, you were looking at my screen because I was just trying to see whether I was able to share it with you or not. And we were looking at a correlation matrix. Correlations between securities is something that is not fixed. It changes through time, but it's very clear that there was significant correlation in the constituents of ULTY at the time. And one of the things that you're probably going to observe if you look at the portfolio now, and you will definitely observe if you look at the portfolio tomorrow, because I know some of the things that they traded today, is that you're going to see other things in there that are intended as a percentage of the portfolio to be non-correlated. Now, I want to make sure that we're kind of clear about what non-correlated is. A non-correlated asset is not the same thing as an anti-correlated asset. An anti-correlated asset, a perfectly anti-correlated asset means that if one asset goes up by 1%, the other one goes down by 1%. If you have a portfolio made of just those two, it does nothing. That's kind of like idyllic from a portfolio manager's point of view, that you can absolutely strictly define the volatility of a portfolio of assets because you know they're pairwise correlations. But unfortunately, pairwise correlations are not perfect, and they do change. But the intent is to introduce some non-correlated constituents. In other words, things that are deliberately included. They're going to still trade like stocks and have options on them because that's what the strategy is all about. The name has not changed. YieldMax Ultra Options Income is still the leading part of the name. But there is a more deliberate approach, I think, to making sure that you don't end up with excess correlation that can drag down the value of the underlying stocks.
Yeah, I saw Costco was added, I think, last week, and Google last week, which are much bigger names than the quantum stocks that you guys had been buying before?
Well, yeah. So, the Google Alphabet, it's interesting. That one got landed on independently by a couple different people at the same time, it would seem. So, as I've said, I'm not the portfolio manager for ULTY, but I was on Fast Money on CNBC last week. It's actually, so on CNBC, we have these things called our annual acronyms, and you have to pick your favorite stocks, your favorite trade themes each year. And one of mine for 2025 was Alphabet, was Google. So, beginning of the year, I mentioned it. Didn't turn out great in the beginning, but I reiterated that last Thursday on Fast Money that I was still in favor of this, and we did buy it. First thing Friday morning, we bought 200,000 shares of it. It turns I did not have a conversation with Mike Venuto or Jay or Scott or any of those guys at the time that we had this conversation. But then the very next morning, I said, "Oh, you guys added 200,000 Google." I was just talking about that. And of course, I watched it with great interest throughout the day. I think we picked up around 275. It did okay. It was still down by the close, but it had definitely rallied a bit because it traded on its lows in the morning. We saw that kind of pattern that we've been seeing a lot of, where the biggest extremes, the real big dips have probably been an opportunity to buy, and similarly, some of the rips have been opportunities to pair a little.
You were mentioning Google and Berkshire Hathaway.
Yeah. So the interesting thing about that was that, I was a big fan of Alphabet at the beginning of the year. I thought the company was cheap. I thought there was just a persistent tendency to underestimate it. There was a cloud hanging over it because at one point there was the risk that they were going to have to divest Chrome. I don't know if you remember, it was like an antitrust concern. That got resolved in their favor. And, I feel like they're at the intersection of a lot of the things that really matter. It's hard to put together, I would say, such an assortment of high quality assets as they have the kind of top line growth, which isn't astronomical. It's not like NVIDIA type growth, but very good top line growth, very good bottom line growth, massive free cash flow, and trading at cheaper multiples than the market overall. I just thought it was kind of a no-brainer. And so on Fast Money last week, on Thursday, I mentioned it again. The guys added it Friday morning. And then after the close, I was just watching the P&L. I was like, what just happened with Alphabet? Because all of a sudden we made like a quick $700,000 in it or something like that. And obviously a lot more since. And I looked at the news. Berkshire Hathaway added 17.9 million shares. And, I immediately got phone calls. People called me up. They're like, "You mentioned it on TV and then you guys bought a couple hundred shares. What did you know? And did you know all about this and that?" No clue. Nobody told me anything. I didn't have any unique intelligence. I mean, I gave my rationale, and the portfolio managers elected to add it independent of me. Maybe they looked at it because they watched Fast Money, or maybe they didn't. I mean, they have their own reason. But as far as I'm concerned, just in terms of timing, a broken clock is right twice a day, as they say, or every now and then a blind squirrel finds a nut. I don't know. I mean, there are good fundamental reasons for owning the business, in my view. Those things remain valid, and it just so happens that Berkshire Hathaway apparently agrees.
Nice, yeah. So one question about ULTY is, do the managers have like a cap on how much gains they would let run up in a single stock, or how much losses they'd be willing to accept in a position before they trade out of it?
I don't think that any trader has a notion that there is a cap on the amount of gains that you are willing to accept in a name. It's not, you don't measure the quality of an investment by how much money you have made or lost in it up until that point. I'm not the guy who coined this phrase, but it's very common in trading, is that you only trade from settlement. That is to say that every day you look at the things that you hold, or that you would buy, or that you would sell, with fresh eyes, with whatever information you have at your disposal at that moment. I have never looked at a position and said, oh, this thing's just too profitable, I got to sell it. However, you may end up selling some of it if it becomes outsized as a part of your portfolio. Now, in this particular instance, it would take something really remarkable to get to the point where you have to do that also for regulatory reasons, which also exist in registered investment companies, which these are, right? So there are actually rules that say you cannot hold more than certain percentages in, for example, you can't have more than 50% of the portfolio in stocks, each of which have more than 5% themselves, right? So you can take a look at a registered investment company and you say, okay, well, I'm going to look at all of their top holdings. And you can look at even highly concentrated ones. In fact, I'll do that right now. So, for example, if I look at something like not one of ours, just like an XLF, right, which is the financials ETF. And one of the things you're going to see is that they've got 12.5% in Berkshire Hathaway. They've got 11% in JP Morgan. They've got 7.5% in Visa and 6% in MasterCard. No other holding, and they have a lot of holdings, is over 5%. And the reason is because you can't have 50% or more of your portfolio concentrated in these positions. Now, what's also interesting, XLF is a little bit different because there's also restrictions as to how much you can hold in certain types of assets unless they are specialized in that. So financials, for example, is an area that have restrictions, right? So that can be a potential restriction. You can't have more than 25% in any one single holding. So these guardrails, which are in place from a regulatory perspective, will also influence it. But in general, ULTY is not trying to make an outsized bet on any given stock. So, if the concentration gets big, you will see some of that get sold off, not because they no longer believe in it, because it's been too profitable, but rather because, there's just concentration issues and you don't want to incorporate too much risk into the portfolio as a result. So nothing gets sold because it's profitable. Now, the inverse of that question is a very valid one to ask, and that is, do you stop yourself out, right? Which I think is another question. Now, in my, I have a couple philosophies that I've always incorporated into my own trading, and that was that we would indeed take positions out of the book or institute measures when they started to roll over badly. Our reasoning for this was because we assumed that there was something going on that we didn't understand. That is to say, whatever it was that got us into this, we didn't get in it to lose money. So if it starts losing money at a rapid rate, something else is going on that we somehow missed. There's another issue, which is maybe we didn't miss it as a risk, but it starts to play out and you say, okay, well, we're just not going to take any more of this. But you do have to evaluate each position. Let me give you an example. And this is not necessarily related to any of our holdings, but I'll just offer it. MicroStrategy, now known as Strategy, is closely tied to Bitcoin. And Bitcoin has been hard hit. Strategy has been hit much, much harder. So it used to trade at a multiple to the value of its underlying Bitcoin holdings, which are now close to 650,000 Bitcoin. And that multiple began to converge. It is now trading probably about 1.2 or less times. Now, if you're wondering how I get to that, you say, well, wait a minute. No, how could that be? Because Strategy, I'll look at this up right now. Strategy's market capitalization is 60,000 and Bitcoin is, let's see what Bitcoin is right now. Bitcoin's 93,000. So someone would say to me, Mike, well, 93,125 to be precise, times 650,000 is $60.5 billion, right? Which is about MicroStrategy's current market capitalization. So you would say it's basically trading for the value of the underlying Bitcoin. And I would say not so fast because they do have some debt on their balance sheet. And some of that debt or the preferreds are convertible securities. So I estimate that to be about a $10 billion claim on the underlying Bitcoin assets. In some cases, struck much higher. But I just dilute the shares by that 10 billion. So instead of calling it 60, I call it 70. And, on that basis, so round numbers, I like back of the napkin. It's trading at 16.6% over the value of its underlying Bitcoin. But why do I bring this up? Because at a certain point, strategy becomes a very interesting investment because you can arguably start to get a form of arbitrage, right? So if it trades at exactly the same price as the Bitcoin holdings when you add back the convertible debt, knowing that the convertible debt is actually struck higher than where the stock currently is, well, I would then be able to buy strategy and short Bitcoin and kind of have an arbitrage, right? Now, there's an operating expense issue which plays into this, but I basically can lock up money. So if I own strategy, even though strategy is down a lot, should I stop myself out and short it at this point because it's down a lot? Or should I be saying, there might be a better way to play this? And a better way to play it would be to say, if I can get this thing 15% below its current price right now and short Bitcoin as a hedge, at the very least, I shouldn't really lose any money. So you do have to evaluate losers. Why am I losing? Am I losing because I have the underlying story wrong, or am I losing just because of the vagaries of the market? Or have those losses actually created a new situation where there's, maybe a functional arbitrage like the one I just described? So it's case specific on the downside, but people should always use significant down moves as a moment of reflection to say, are we right about this? I mean, why are we in this thing in the first place? If you don't have a good answer, then chances are you should exit those positions.
Is that, I don't know if you have the insight, but is that how the managers felt about some of the quantum or crypto related stocks a few months ago? Because like you mentioned, they had maybe 6 crypto related holdings, some of them pretty small companies that are like treasury companies for Bitcoin or Ethereum.
So, like I said, I'm not a part of every conversation.
Sure.
With the strategist role, we have over 60 funds at this point, and I'm often doing things. I'm sure they're talking right now. We have 40 traders, and there's 2 that are heavily focused on the activities in ULTY basically around the clock, and I'm sure they are talking all the time. In fact, I know that because I will sometimes see things in a chat window that comes up where the 2 of them are communicating with other people in the trading teams and the investment teams. So there's a lot of conversation that goes on that I don't hear, but I do know a little bit about how these guys think and the things that they're trying to focus on. It is entirely possible that one of the things that happened was related to the correlations that I was talking about earlier, is that as correlations change and as correlations rise, for whatever reason, like those correlations may be spurious. That means that there's not a causal relationship. So there's a causal relationship between the price of Bitcoin and the price of strategy, right? But you can also find situations where you just find that there are pairwise correlations that are high that make a portfolio behave in ways you don't like, that you need to resolve whether there's good, definable reason for it or not, right? So you could have two companies that trade in lockstep with one another, and you're quite convinced that their circumstances are very different, and they really shouldn't be trading with each other. But if they are, you might end up having implications for the broader portfolio that are unattractive, and so that may force your hand. I mean, one of my colleagues from CNBC has a habit of saying, price is truth, and portfolio managers do have to contend with the fact that all of your work in your spreadsheets, everything that you do, may point you to a direction of saying, I think I can buy $10 for $7 over here, and we therefore should do that. But if you're doing that across a bunch of things and they're all behaving very badly when you put them together, even if your original analysis suggested that they should not because of changes in correlations, then you need to look at your portfolio construction, and that can also force some changes as well.
Gotcha. Going back to kind of the portfolio construction, how much of the selection for ULTY is like rules based or just defined in the prospectus versus at the discretion of some human beings and how they feel?
How they feel? Well,
Like, are they just looking for the most volatile, or are there a set of screens they use?
okay. So even if you were just looking for high volatility, that isn't an issue of feel. That's quantifiable, right?
Right.
So I don't know. I've yet to find any traders or portfolio managers who do things just by feel. Actually, no, that's not true. I knew one. I remember I asked him. He was a very effective products trader. So he traded heating oil and gasoline against crude and things. And I asked him one time because he would go down, and I said, "Where's your process?" Well, the rest of us are spending all of our time looking at spreadsheets and models, and we're tweaking those throughout the day. And he's like, I feel the wave. Like, the wave? I was like, I don't know what that means. It was totally meaningless to me. I think it's meaningless to most people. So everybody has a basis. So there are various factors that can go into security selection. One of the things that is certainly being evaluated is that those factors led to a portfolio construction where the correlation, the pairwise correlation between constituents in the portfolio was larger than we would have liked. I think it's safe to say. And so those things are being revisited. And, I was literally just taking a look at a list of some of the factors. So that's what we refer to these things as. Like, why do you buy something? Why do you sell it? What are the things that go into that calculus? Those are factors. Those factors could be technical. They could be fundamental. They could be some combination of these. Let me give you some more concrete examples. Volatility matters. So what is the implied volatility? You're not going to see a whole lot of stuff in there with an implied volatility of 18 because there's not a lot of premium to be collected by selling options on that. Other factors might be of a technical nature. Is the stock above its 50-day moving average? This is not because I'm a technical analyst. I personally am not a technical analyst, but I do factor analysis. And the fact is that this is a factor that actually has a sharp over to. This is a factor where if you choose stocks that are above or well above their 50-day moving average and compare it to the performance of stocks that are below it over large samples of stock, over large periods of time, the fact of the matter is that the top quintile is going to outperform the bottom quintile over time. This is not me coming up with this. This is the data. A lot of quantitative analysis has demonstrated this. And there's a lot of factors. Within my screens, there are 235 factors that are used. Those factors, some of them are meaningless. They don't, in other words, we evaluate those factors, but the quantitative data suggests that they don't actually have important implications for stock picking 30 days out, 90 days out, or a year out. But some of them actually do. Now, I don't mind sharing some. I'm not going to give them all.
Yeah.
But there are some fundamental factors that matter. Let me give you some examples of things that we might care about. Have there been recent revenue or earnings revisions, higher or lower, within the last month? So if the sell side is in the process of saying, our revenue assumptions were wrong, and they're revising these things down, or they're revising their adjusted EPS estimates for next year down, how often is that followed by really good performance for stocks? I'll tell you what the facts say, but then I'll ask you what your intuition is. Your intuition is probably that the sell side analysts are a little slow to the game. By the time they start figuring out that something should go down, they're rarely aggressive enough in their downgrades. The other thing is that market participants don't respond immediately, but they do respond. And so you take a look at revisions, negative revisions. In general, stocks that have negative revisions underperform stocks that had positive revisions a month later. And again, this is not my opinion. This is just what the data shows. So we evaluate a lot of those factors. Some of them get more weight, some of them get less, some of them get none, some of them don't deserve any. But there is a lot of factors that go into stock selection. And that has to occur in a universe of stocks that is actually tradable, meaning that if you have $1 billion or $2 billion and you've got 20 constituents, that means that even the smaller positions, if it's 3% of a $2 billion portfolio, that's $60 million, right? So you have to have liquidity. You know, as an individual, I can buy or sell any amount of stock that I want to with very little concern, because 1,000 shares of a stock is not difficult to get off. You know, 1,000 shares of Netflix, you know, it's $1.2 million, but I could trade that pretty easily in my self-directed account. You know, it's just use the little mouse and buy, sell. That's it. When you're managing a portfolio, though, it's not so simple. How tight are the option spreads? These things matter. Are the lit markets reflective of the real markets? Because the portfolio managers aren't out there click trading these things. They're doing RFQs, meaning that they're cross-shopping dealers, trying to see who's got the best price in a spread that we're going to trade 5,000, 10,000 times. So all of these things are factors that go into it that probably, you know, someone who's looking at it from the outside, they may or may not see that. As they think about it, I'm sure they're thinking, oh yeah, well, of course. I mean, I trade 50 lot spread, so I never even thought of that. But if I was trading 5,000, it becomes important. So liquidity, all of the underlying factors that go into whether or not we like the stock, the price of the options, the liquidity of the options, the spreads in the options. That's not all. Corporate actions, have there been any? Are we anticipating any? You know, what catalysts are on the horizon? We have positions in NVIDIA. NVIDIA is relatively late in the quarterly earnings reporting cycle. Do we want to maintain, you know, those positions through that event? So all of those things are going to be going into it. When you take a look at the constituents in these different funds where the fund managers have discretion. Not just ours, but this is true for every fund manager. They have to contend with us.
Sure. What would you say to someone who maybe held on to ULTY for the last year and sold recently when it was, you know, going below 5 and now around 420? What would you say are like the pros and cons of holding ULTY?
Yeah, so the first thing I would say is that one of the things about a high distributing security, not just ours, any high distribution security, is that you can't look at the price chart as necessarily, it doesn't mean the same thing, because a large portion of your total returns may not be coming from price changes in the underlying security. It may be a contributing factor in some of those that are appreciated. So in the target 12 space, we've got Biggie. Most of it's still coming from distributions. So if you're using a technical indicator to establish whether or not you want to be long one of these funds, that's probably not a good approach. I would look at the constituents and say, is this a basket of stocks that I want to be in? Is this a basket of stocks I want to sell premium against? You can see the fund holdings. So that's what I would instead look at. I realize it's more work for the investor to do that. We publish it. It's on the website. Maybe you don't have a Bloomberg terminal or a trading view or whatever it is that you might use to analyze these things. But, you know, I mean, again, so if you're looking at ULTY and saying, okay, is this a portfolio of stocks that I like? Take a look at its biggest constituents. And those in order are, I'm going to see if I can sort this by market value. You have Palantir, Robinhood, Coinbase are still in there, but also NVIDIA. Alphabet is obviously, Costco is probably a pretty stable name. You know, that one's in there. Like I said, is the market still open right now?
Yeah, we got 1 hour left.
Okay. Well, there have been other things that have been added. Okay.
Yeah.
That people will see after the close. I'm not going to preempt anything that the fund discloses on a normal basis.
Sure.
And also, I mean, I would have to pull up the blotter to see whether there are other things that the fund managers have been trading. But you need to have comfort with the underpinning securities that are in there. And if you do, and if you're comfortable with the strategy, then I would say that's really what should guide your decision making. That's way more important, because the price chart, since it doesn't include the distributions, is not going to be that revealing. Now, independently, just talking about total returns, I could understand why people might be a little bit anxious if they've seen the performance since that high on October 9th that I referenced, right? Because a lot of people have illustrated that they are not comfortable with these stocks. You can take a look at MicroStrategy, and you can take a look at Coinbase, you can take a look at Bitmine Immersion. Some of these things we don't have big holdings of in ULTY anymore necessarily, but there was a sharp reversal in a lot of that high-flying stuff. It seems like it's caught its footing a little bit. I think it's okay for me to say that the net flows today actually were positive in ULTY. So there was more people bought than sold ULTY today. And I have a feeling it's because some people are also saying, I like these underlying assets, and I think the recent downdraft is overdone. Mm-hmm. And they're figuring maybe now is time to take advantage of it. And I can get that because we saw the VIX go up. These things sell options. So if options premiums are higher, they're getting to harvest that. If they think some of these stocks are oversold, they get to take advantage of that. In Alphabet's case, it's a little harder to say I'm getting it at a bargain price because it's basically close to I think it's at its highs of the year. I still think it's a reasonably valued company, but you're not really being punished for buying ULTY by saying, oh, well, that means I'm chasing Alphabet, because it's actually one of the smaller holdings in the fund. And typically after you see this kind of a run, that's going to be relatively stable. What do we have our percentage right now? And that floats because the stock is moving around. So it's 3.3%, $57 million in Alphabet.
Will ULTY ever hold more than kind of the 22 positions? Are they capped at how many holdings they can have?
So, well, there's a couple things I would say, and that is that I don't know if this got to, I think there were some minor changes that were going to be coming to the prospectus. I don't know if those have been filed. I know they've been discussed internally. Mm-hmm. More stocks than 20 can go in. Well, there's more stocks than 20 in it now. There's 22. I think that there is, if a fund gets too big in terms of the number of individual stocks, it just becomes hard. That is also a challenge for the managers to do that effectively. You sure. Want to have 1,000 stocks. I mean, you could do it, I suppose. You could just say, okay, well, I'm going to mimic the Russell, right? I don't really see that makes much sense either, though, because based on my analysis, at least, there are factors one can look at that are likely to deliver in a strategy like this better risk-adjusted rates of return over time than simply grabbing an index and saying we're going to do that. But you can get very good returns that way. Biggie is a good example. I think that's a good number of stocks. Biggie's got 50 stocks in it, and it's had very nice returns. It's outperformed the S&P on a total return basis considerably. I think it had lower drawdowns, comparable volatility, paid big distributions, and outperformed. That's, I think, what a fund manager would normally refer to as a hat trick. So, there can be benefits in a little bit more diversification, but I would offer, most of the academic research, as long as you're not buying all stocks in the same space, and this goes to that pairwise conversation I was talking about before, most of the benefits of diversification can be achieved with about 10 holdings, like 80%. I think you're up to about 90% of the benefits of diversification once you have up to 20, unless you have pairwise correlations problems. And so that's obviously something that every fund manager has to keep an eye on. So you don't want to have excess concentration, unless that's the intent. If you have SOXY, Chippy, these are thematic baskets of stocks, and they're going to correlate to chips or semis or whatever. And people should expect that. And we do, and we assume that investors get that as well.
Yeah, hopefully if you're getting into that, you know what you're buying. One kind of just random question was, are there any regulations or things that make it difficult to be an ETF manager that you would get rid of? Or kind of
there are look, I mean, it's always a loaded thing. I'm not any regulators that might be watching. I'm not saying that your jobs are easy either, right?
Sure.
I would say, first of all, I do wish. I don't think that the tax treatment is entirely fair, and I think that the tax characterization issue is it can be a little bit silly. Um, One of the things about a registered investment company is that to be considered a pass-through entity, you must pass 90% of all gains, income, etc., back to investors. In funds of this type, that has a very significant effect. We don't get to say we want to try to, for example, stabilize the NAV at, say, $20. So let's say I said, I want a $20 NAV, and when we make more money, we will just try to make a regular distribution, and then we'll sort of accrue for potential drawdowns on the underlying stocks. Wouldn't that be nice? Or better yet, can you imagine if you had a NAV that was almost exactly like Biggie? Biggie is appreciating a little bit faster than inflation and then handing off 1% a month. That's very handy. But in a discretionary fund, this is really hard to achieve. And why is that? Because if we make a purchase and then realize a gain, you cannot hold that gain from whatever source it was derived. If it exceeds more than 10% of the value of the fund by the end of the year, you must hand it back. So if you have to hand all the gains that you make back, and you have to hand all the income that you make back, then functionally the NAV of the shares is going to be generally pretty flat, or it's going to trend downwards. Because every single time you make money, you have to give it back to the investor, or else you're subject to corporate income tax, which is 30%. I wish that wasn't true.
Mm-hmm.
I wish we had more flexibility in that area. Now, if it is if it's for an investor that's in a tax-free account and they monitor that themselves and they just drip it, in other words, when they see that the NAV dropped and they get a distribution, they say, you know what, I want to make sure that I have the same amount allocated. It's going to increase my share count, but I want to keep the same amount in there. And then I'll evaluate the performance at the end of the period because it doesn't have any tax implications for me. That's fine. Trusts, endowments, non-taxed entities, they can do that sort of thing. But I do wish we had a little bit more flexibility there. Some of the other rules, I understand why they are there, which is to say that I can imagine the utility of relaxing some of them, but I also understand why the rules are there. So I have to say, what's good for me as a fund manager and what is good for the marketplace. And those two things aren't always in perfect alignment. You have this sort of greater good that you kind of think about. I've often said, when I was a market maker in the options world, that there were things that we didn't like about it. But I understood why those rules were there. I didn't think it was fair to us, but I understood why the rules were there for the benefit of the marketplace at large. And sometimes you do have to think about the bigger picture, or just accept that there are other people who will think about the bigger picture. And I'm sure there's a couple different things that I would possibly change if I had an opportunity to debate it with the people who make policy. But that we can live with the rule set we have. I think ETFs are a good product, even the way they are, even if there are little things I'd like to improve here or there.
Yeah, that 90% one.
It's annoying.
Matt.
Yeah.
Okay, well, pretty much all my questions. Is there anything you want to leave the audience with? A lot of my viewers own ULTY. A lot of them have sold ULTY. A lot of them have gone into WPay. So anything that, I guess, in the last 7 minutes that you want to leave the viewers with?
Well, a couple things. Always just know what you're buying. I have said this many, many times about these products and about the products of other people. I don't denigrate any competitor's products either.
Sure.
Although I've certainly seen some other people do that. A lot of products have utility and they have uses that, I think people looking on the outside didn't see. Sometimes you have accounts that can't trade options, so these types of products are useful for that. The same thing goes for leverage, right? So sometimes people don't have easy access to leverage, but they want to deploy it. And used wisely, it can be a powerful tool. We don't deploy leverage in the funds that we have, but I can appreciate why those products exist, and I'm not going to knock them for that. But do know what you're buying, because I have seen some of these products compared with others because they have distributions. But it's the underpinning strategy that matters more when you're selecting one fund over another. Because if one uses leverage to achieve larger distributions, it's taking more risk in many cases. Is that risk you're comfortable with? No. Look at what the fund's holdings are. In the case of ULTY, the strategy is that there's a little bit of, actually, I would say important and material changes in the security selection process that have taken place, because the securities that existed between April and October had relationships to one another that introduced more risk than I think not only we are comfortable with, but it is very clear to us that investors were not entirely comfortable with the risk of having so many really high beta stocks that could have at various times higher correlations. So that is definitely changing. And so I think that's an important consideration. People should pay attention to that. Just for YieldMax more broadly, I would also say people should pay. We have these Target 25s coming out, which I think are going to be very interesting. But I would also say to people who are looking at diversified funds and are looking for NAV stability, things like the Target 12s tend to exhibit that because they are intended to capture a little bit of the upside as well, or even sometimes a lot of upside. So, and that goes back to the same thing. So the answer is always know what it is you're buying. And I think if you do that, I think that a lot of these funds do what's on the tin, as they say. I think that's a British saying, but they're employing the strategies that they say they are. They provide transparency in the underlying stocks, and that's it. And we are, just like every investor, trying to improve what we do every day. Not perfect all the time, but I'm pretty excited about some of the changes that are taking place. And I know you talk about ULTY a lot, and ULTY in particular, because I can tell you that this is something that's getting quite a lot of focus internally right now.
Great. Yeah. I look forward to when you guys post those new trades today. I can't wait to see what you bought. So
Yeah.
that'll be exciting. Thanks, Mike. Thanks so much for taking the time to do the interview. Is there any place you would point viewers to if they want to learn more about what you do or YieldMax or me?
Well, I mean, the as many will know, the YieldMax newer website is up, and I think there's more information available there than there was in the old one, or at the very least, it seems to be easier to find it. That has been my experience using the website. It's also very fancy. It's got a lot of moving things. So, if you're prone to motion sickness, a lot of moving stuff on the website, but the website's a really valuable place. I do my own live streams where people can just ask me questions twice a week. So 4:15 Eastern time on openinterest.pro/live. That'll just take you to the YouTube channel, and then we have a chat. You can just ask me questions, and I'll tell you, my answer at that time. So that's probably the best way to reach me if you have questions and you want me to show stuff, because I will pull up screens and work through things in real time for you.
Okay, great. Thanks, Mike. I'll end the recording there.